Hello, everyone. Thank you for taking the time to join us for today's webinar, Inflation, Disparities, and Regional Economies. My name is Dee Scott, Marketing Administrator here at REMI, and I have the pleasure of serving as your webinar host this afternoon. Our speakers today will be REMI CEO and Chief Economist, Fred Trays, and Analyst May Lin. Dr. Fred Trays is an authority on analyzing public policies and their regional, macroeconomic, and population impacts. Under Dr. Trays' leadership, REMI has shaped public policy debates by helping clients evaluate economic development, transportation, energy, immigration reform, and other topics. Dr. Trays holds a bachelor's in economics from Princeton University and a PhD in regional science from the University of Pennsylvania. May Lin supports several clients across the globe with their economic modeling needs. She works to ensure every user can incorporate the REMI model into their organization as effectively as possible. Ms. Lin holds a bachelor's degree in economics from Purdue University and a master's degree in statistics from Washington University in St. Louis. Following the discussion, there will be an opportunity to have your questions answered. Please feel free to submit your questions in the Q&A submission portal at any time during today's discussion to be answered later by the presenters. For your convenience, all registrants for this webinar will receive direct access to the webinar slides and recording via follow-up email. Without further ado, I will hand it off to Fred and May to begin the presentation.
Okay. Thank you so much, Dee. So I'd like to take the first part of the presentation, and then I'll turn it over to May, and then we'll have Q&A at the end. So today we wanted to talk about inflation, disparities in regional economies, and of course, inflation has been the big headline in economic news. Followed up by the Fed indicating that they're going to slow down on their asset purchases, eventually unwinding them, increasing interest rates. Lots of different macroeconomic issues in terms of where the economy is going, all related to COVID, as that is an ongoing concern. We're going to focus specifically. Not try to tackle everything in this category, but focusing specifically on what inflation means to wage compensation, income disparities, how we can measure that, why it's a particularly concerning issue for middle and lower income groups, and then also where we feel we have a lot to contribute is on the regional economic dynamics of what's been going on in inflation, and also sort of the restructuring of the economy around remote work, distance, and all sorts of changes that have been happening post-pandemic. So I'd like just to introduce this topic a little bit, and then I want to go get into some specifics of what we're going to be doing. I'd like to introduce generally the inflation issue, then look at the topic of the regional disparities, go on to show the inflation impacts by wage and income, and then hone in on regional housing price dynamics, which is something that's been of large concern and has really been driven by a restructuring and reshuffling of the economy. The Great Resignation is something that also people have been talking about, and we'll be looking at how changes in the labor markets influence inflation and influence resignation. Conclude, and then I look forward to a very active Q&A session. So just who we are, the nation's leader in regional economic policy modeling, so that using REMI models, users can ask what-if questions about the effect of policies or other economic changes and how they impact the regional and macro economy, jobs, output, income, and we're very mission-driven at REMI to support communication and better public policy by providing analysis and information to help guide policy formulation. If we look at the broad topic of inflation, and again, we want to just hone in on some particular aspects within regional economies, but the big broad picture is like, why isn't inflation such an issue right now? Why is it 6% plus year over year, and expected to continue that way for at least the next several months. Well, what's leading to all this really is an outcome of what happened in the beginning of 2020 when the COVID pandemic hit, and there was a rapid response with both monetary and fiscal policy, where monetary policy was quantitative easing for the monetary authorities to actually go into the market, buy T-bills, mortgage-backed assets, a near zero federal funds rate, really like the whole bazooka of like conventional and unconventional expansionary monetary policy. This was paired up with fiscal policy, which also worked hand in hand with monetary policy with massive federal spending packages, the CARES Act, the American Rescue Plan, payroll protection, extended unemployment, cash payouts, quote unquote stimulus checks. So it really led to a lot of sort of counteracting what looked like a severe deleveraging that was beginning to occur in March 2020, where there was just a massive pullback in employment, people losing jobs, businesses pulling back. So really what we would call a deleveraging, and the monetary and fiscal authorities went in very aggressively to counteract that, and to a large extent has sort of succeeded in stabilizing the things, at least so the economy doesn't go into like another great depression. But now we're sort of dealing with the overhang of this. Is it too much expansionary policy, combined with what we've seen as supply chain disruptions, the closure of factories. So there was a shortage of production, then it rebounded, a shift from services to goods, an increase in imports as we have all this expansionary fiscal policy. The trade deficit has increased, so we're importing more from overseas, shocks to specific components, which led to things such as the motor vehicle plant shutdown and the price increases. And then also labor shortages with the Great Resignation, quote unquote, early retirement. We'll see later on that the entire population of the U.S. grew by only 0.1% as international birth rates went down, international migration went down, and survival rates declined. More people died due to the pandemic and other factors. So then there are labor shortages, which have led to tight labor markets, increasing prices for businesses, which could then be passed on to consumers. So there's been a lot of discussion of this in the press, and these seem to be the major areas driving the inflationary factors. Now, this sort of overlays maybe some deflationary factors that we haven't really been thinking about that much. Well, one that people do think of and use on a day-to-day basis is technology. So not only the iPhones and the computer technology and the remote technology, but even more automation with self-checkout and other technologies, which may increase productivity, which should lead to lower prices. If the same number of workers can produce more, that should tend to be deflationary or mitigate inflation. Globalization is still long run occurring. There are these supply chain disruptions this year, but there still is room to go for continuing to have imports into the United States from low-cost countries and exports from the U.S. So kind of that comparative advantage leading to more worldwide efficiency and lower prices. We also have the aging of the population. So we've seen in Germany or Japan first, and then Germany and Europe, that as the population gets older, retired folks tend to be risk averse. They're not the ones buying GameStop. They're not the ones in the hottest but most uncertain technology, and that tendency of an older population, particularly a retired population, to emphasize preservation of capital leads to fairly high savings rates, which then and lower levels of consumption, taking pressure off the economy. And in the case of Japan and to some extent Europe, we've seen it's actually can have a deflationary effect. And then finally, another potentially deflationary factor is the adoption of mass remote and hybrid work, allowing people, firms and workers to shift production or residence to a lower cost location. So they're taking some of the pricing pressures out of the big San Franciscos and Chicagos and other big cities. So that's kind of the broad macro context. And then, but we wanted to get into issues dealing specifically with the regional dimension, and then also specifically with income and wage disparities. So the topic we want to look at is first focusing the inflation issue on the impacts on middle and lower income people. And we can just illustrate this first looking at motor vehicle prices sort of very simply, and then we have a somewhat more complex dynamic going on in terms of housing and rents. And then that housing price effect we wanted to look at further in terms of the regional dynamics of housing prices in a more footloose economy, where people have actually shifted the location of where they work within a metropolitan area, like city to suburbs to exurbs, and then also regionally across the national economy. So the north to south, north to south, generally speaking. And then we have some simulations in the REMI model to illustrate how we can model and evaluate some of these effects in a economic modeling environment. And that would be first the regional impact of housing and rental inflation on wage groups, just a snapshot for what's happened in 2021. Second, an example of the impact of regional housing prices on just one aspect of labor market changes, which is the increased level of early retirement. And we'll look at a simulation of retirees moving from New York to Florida and how that impacts housing prices and the economy. And then also sort of a modeling simulation showing that remote hybrid work not only can lead towards a dispersion of economic activity with people moving to lower cost locations, but also could have an effect on increasing industry concentration. For example, if a major industry in a big city is now able to access a highly skilled workforce from all over the country, that can in fact increase the productivity of the core cluster of the industry and increase industry concentration, sort of counterintuitively, because you might think that lower commuting costs and remote work would just end up distributing economic activity much more widely instead of leading to industry concentration. So we have some fun modeling exercises that we're going to be doing in part of this presentation. So first, looking at inflation impacts by wage and income group, I think it's something that's certainly on a political level, we certainly see a lot of stress about inflation from the electorate. And I think it's important to recognize that inflation is particularly difficult for middle and lower income individuals, and then especially where we've seen things like used motor vehicles go up at a faster pace than new motor vehicles. So first, lower income households are spending a higher proportion of their income on necessities such as gasoline, housing, food. And these are three different areas where prices have gone up very dramatically, like gas prices have gone up, housing prices have gone up, food prices have gone up faster than the general basket of goods and services. And then since the items for lower income groups are necessities, when prices go up, there's not much give. So if it's a necessity to drive to work in a daily commute and the price of gasoline goes up, there's really no choice but to spend more on that, and there's not a lot to cut back on. But for a higher income group, there's a lot of discretionary spending on luxury items. So if there's inflation, a higher income household can adjust to this more easily because it really means giving up some of the luxuries to be able to afford all of the necessities of life. Secondly, the higher wealth individuals have disproportionately benefited from monetary policy and asset appreciation, so that higher income, higher wealth households, which came into 2020 with home ownership and stocks and bonds and a 401k account and so on, now that there's been this additional liquidity, which has raised the price, inflated the price of assets, those who started out with assets to begin with have benefited from that. Again, so then price inflation isn't so much a concern, as the wealth has increased so much during this last time period. And then also the disruption effect of COVID hit middle and lower income workers disproportionately. And of course, we're hearing a lot of this work for home, but the work from home jobs typically are highly educated professionals doing that type of work and higher income, so that the COVID disruption has been particularly disrupted to the employment of middle and lower income workers. And here's just an example: the rise in motor vehicle prices, and we see here that the consumer price index for used vehicles has jumped a lot faster than that for used cars. Used up 25%, new vehicles up 5%. And then if we see this in terms of distribution across different income groups, and this model comes out of the REMI socioeconomic indicators model. We've run a simulation with the new motor vehicle prices up by 5%, used motor vehicle up by 25%, and we can see that this has the biggest effect on the middle income group. Actually, because of the use of public transportation, a little bit of less of an inflationary impact on the two lowest quintiles. But then also one need to recognize that for a middle and lower income household, a purchase of a used motor vehicle is oftentimes absolutely necessary because it's required to get around, get to work. And if the new motor vehicle prices go too much, expand too much, then some of those new vehicle purchases can just be deferred for a couple of years. So inflation is a little bit easier to escape for those who are buying these new vehicles. So that's just sort of a very sort of straightforward idea is that the inflation is not equal across all individuals and across all baskets of consumption. And then especially we see a big divergence in terms of regional housing prices and what's going on in that market. This is just a little bit more to set up because there's a significant regional dimension, how things play across space and distance on a metropolitan level or national level. So I'd like to explain the argument or the narrative that we're trying to say here, and then build on that, and then we have a policy simulation. So first, the first premise is that remote and hybrid work will likely persist at a much higher level than pre-COVID. In other words, we're not necessarily going to snap back to like everybody in the office as things were in the beginning of 2020. Secondly, the premise is that residential location is less tied to commuting to city centers. So kind of in the pre-COVID world is getting to your workplace in person every day was a top priority, and therefore you're willing to pay more for housing and substantially more for housing that's located very close to the place of work. And then if it's more footloose, then we see that there's less of a need to pay that premium rent and that high population density near city centers, and there's some immediate shock of an increase in the migration to the suburbs in the South and the West, and also we suggest that some of that is going to persist. But then if people are moving from a high cost location to a lower cost location, this tends to have the effect of increasing the rents in the lower cost locations. So for the person who's moving, it looks like they're getting a steal by moving from New York to Florida, and they can get more house for their buck in Florida. But then for people who are currently living in Florida, they just see the influx of Northerners coming in and driving up their rental rates. So the first step in sort of this discussion is, to what extent will remote or hybrid work be persistent? And this just shows the average office occupancy of the top 10 cities. So it certainly has gone up quite a bit from the lowest levels of sort of in the depths of the pandemic. But even now, well over 6 months from a vaccine, we're only up at 40%, and we would expect that amount of office occupancy to climb into the future. But especially when you look relative to the workforce, we would suggest it's never going to go back exactly up to that 100% where it is before. Maybe it'll level off somewhere between 60 to 80%. I mean, there's a lot of uncertainty, so this is just a guess. So what does it mean if one doesn't need to report, or many people? I mean, obviously office work is only a very small segment of the economy, but still it involves millions and millions and millions of people. What if there's less of a need to report to the center city workplace office on a daily basis, and instead it shifts to 3 times a week or once a month or fully remote. Well, in that case, there's going to be less need or willingness to pay for a residential location near the major downtown office centers. This will tend to push up housing prices in further out locations relative to close-in locations. And we can look at this not only from a metropolitan level, but sort of from the north-south dynamics, the north-south questions, where the more expensive, more densely urban north city centers are now relatively less desirable from the lower cost southern cities and southern areas, so that there would tend to be some dispersion and movement into these locations. And we can see this graphically in terms of what's called the bid rent curve. And the bid rent curve is basically explaining what drives the rents price per square foot of land, or this could also convert into housing. I mean, of course, housing you can build up so that some of that rental price of land is dispersed by building higher density as you got closer in. But on the x-axis, we see this location here is the central business district, we'll call it. So we assume that workers all need to commute from a housing location at some distance d from the central business district into the central business district on a daily basis. And then if there's no remote working, you can only commute so far until you're out of the urban fringe, where there's flat agricultural land. But as you get closer in, you have to pay more for housing, and you're willing to pay more housing because you avoid those commuting costs. Then when you have more remote working, now if you're living way out here at R1, a distant exurb, well, you only maybe need to go into the office, into the central business district several times a month. So now your commuting costs have gone way down, and you can have a lower land cost, a bigger house further out from the city center. So we see a whole shift in the bid rent curve. And we could also look at this as, quote unquote, the north-south issue, where you can say, instead of the central business district in a city like Chicago, and these would be the suburbs, we could say, well, sort of the central business centers for the US economy are like northern city centers, so northern and Pacific. So San Francisco, Seattle, Chicago, New York, Washington, and then the other areas of the country would be a less dense area, southern area, or also amenities are very attractive to people. So we find lower costs and higher amenities in the South, and then the Mountain West. So if we kind of think of inflation and housing prices, suppose you have a worker in a coastal or northern city where the housing price is 1.9 times the average US housing price. Well, if somebody moves from there, where your house is 190,000, or your unit is that much, and moves to a major city in the South, essentially you've cut your housing price in half. So from the point of view of the worker who lives in one of these expensive cities in the north, who then relocates to the south, you've cut your housing price in half, which is significantly deflationary from your perspective as an individual household. But then we'll see that this drives up the rents to the places where people are moving to. So from the point of view of the resident of the southern city, is rents are going up. It's not cheaper housing, it's more expensive housing. And at this point, I would like to turn the presentation over to Mei Lin, who will provide some examples.
Thank you, Fred. I'll take it over from here. So for this housing and rent topic, we gathered data for rent in 2020 and 2021, and then we calculated the annual change by region from our permit list. Among the 9 regions in a model, San Francisco is the only region that has decreased rents, where rents in Miami, Florida go by 12%. We input the rent changes, which are the numbers on the right column, into PI Plus and simulated the scenario. In the results, price index shows the inflation caused by increasing rents. We can see that the green bar, Miami, and the orange bar, Atlanta, and the gray bar, the rest of US. So for these 3 regions, price index is higher than the national price increase. Well, the only price drop is shown in San Francisco. This graph shows consumption price by income quintile for the United States. We can tell that as rent goes up, life has become harder and harder for low-income people, especially for people with the lowest 20% income. Consumption price increased by 2.7%. Besides the national level, we can also look into prices for aggregated regions. We put major cities like coastal and northern cities together and southern major cities together. We noticed that consumption price increases are much higher in southern major cities in the rest of US than that in the coastal northern major cities. After the regional housing price dynamics, another very hot topic these days is the Great Resignation. In response to the outbreak, the Fed increased cash reserves and liquidity, and then boosted asset prices. An unexpected symptom of the pandemic shutdown has been something called the Great Resignation. For months, a record number of workers quit their jobs. This started in April of this year. The BLS reported that more Americans quit their jobs that month than any other time in history. Then it happened again and again. Workers were quitting their jobs in droves, and it's tapered off, but Americans continues to clock out. Goldman Sachs reported that more than 55% of the resigned people are over 45 years old. This is pretty high to the United States. It means a lot of people are leaving the labor force, which is a reasonable situation at this time. It is also noticeable that the population only grew by 0.1% for the United States. The slow growth is mainly due to the high death rate and a low birth rate during the pandemic. The states that are losing populations include New York and also Illinois, because there's Chicago, San Francisco, which lies in California and DC area, while those gaining population are the states with lower costs and higher life quality. Also, combining the Great Resignation and the population changes, a representative individual would be someone who has enough money to retire and moves from New York to Florida. We're simulating this scenario in PI+. So the model simulates a 10,000 transfer in retired migration from New York to Florida. This means we have 10,000 representative individuals moving from New York to Florida. And this is an inflationary for Florida, especially for Miami, the region we have in the model. As pension holder moves to Florida, rents increase and middle-class renters see the price skyrocketing. This model result on the left shows relative housing price by region. We can see a large increase in Florida and a decrease in New York. Again, the same model simulation. We can also look at consumption price by income quintile in Miami, Florida. This shows that Florida rents go up, people move in from other states, drives rents up, making it worse for lower income people. So for each year, we can notice that for the lowest 20% group of people, the inflation is having the largest impact for them. Besides the Great Resignation, labor access is another main reason for relocation. Remote or hybrid effectively gives worker and firms better access, and this can lead to two opposite directions, dispersing and concentrating. Dispersing or deconcentrating is much easier to understand. Like for the firms, it costs them less to hire someone living in places with lower living costs. People with less commuting needs would move out of the cities with high prices for commodities, including land, rentals, and housing. Therefore, regions around major cities are preferred than those major cities themselves. On the other hand, there are concentrating factors like industry cluster, which means employees are highly skilled in a sector. Their network, interactions, and facilities all locate in a certain region. Examples include people connected in Silicon Valley have more access to experienced tech workers, and in DC area, politics-related work often requires offline meetings. Although there are effects from dispersive factors, worker can access New York from like remote location. There are concentrating cases. For example, if we increase labor force access by 5% in the model, especially in the industry of financial securities. In the results, we can see the concentrating factor having a larger impact. Here, it means employer can cherry-pick some worker outside of New York, enhancing productivity of New York headquarters. And also, there's higher productivity at New York headquarters, increases employment in New York. This is because financial security shows a very high industry cluster, especially in New York. There are also other examples. For example, post-war reduction of trade and transportation barriers has led to global concentration in semiconductors, financial services, and stocks. I didn't know it before, but in China, there is a stock town called Datang, where it produces 35% of world stock production. Also, remote work, including better integration of branch office workforce, could disproportionately increase productivity of headquarters for Amazon, Google, Microsoft, and other tech companies. So for conclusion, we've gone through a lot of topics here: inflation, inequality, and relocation. For inflation, it's rising after monetary fiscal stimulus and pandemic disruption. It's not the 70s, it's not 1999, it's 2021. There's no muscle memory for this kind of economy, said by Diane Swonk. Inflation is further impacting lower and mid-income workers more heavily than higher income groups. And both factors, inflation and inequality, results in relocation, or they reflect in relocation. The regional relocation causes inflation for destination locations that have low cost, high amenity, for example, southern and other cities, and suburban locations as well. And in REMI-PI Plus, the regional economic model, we were able to inform analysis of macroeconomic and socioeconomic indicators as well. So in REMI models, we're able to test out scenarios related to all three topics we've gone through.